old and good friend. Should I say it again? Thank you for coming. I guess that's obvious. I'd like to introduce my very old friend and trusted colleague, Stephen Figlewski. I've known him for a long time. He was running the NASDAQ Derivatives Seminar at NYU Stern for so many years, and I tried to go to that whenever I could, even when I was living far away. I have to tell you, it was a great thing you established there. Today, Steve's going to talk to us about, the title is Beyond Black and Scholes, what can the Q distribution tell us about the risk neutralization process? And I've been talking in my class just today about the P and the Q distributions, so it's perfect timing for some students here. So Steve is the Emeritus Professor of Finance at NYU Stern. He holds a BA in Economics from Princeton and an economics, PhD in Economics from MIT. Has published extensively in academic journals about financial futures and options. Was the founding editor of the Journal of Derivatives and now edits SSRN's Derivatives e-Journal. He was the founder and director of the NASDAQ program, as I mentioned, the Derivatives Research Project at Stern. Professor Figlewski has also worked on Wall Street, at first Boston, then at Citi, and was a member of the New York Futures Exchange and a competitive option traders at the NYSE. So everyone, please join me in welcoming Professor Stephen Figlewski.
Thank you very much. I'm very pleased to be here. Thank you for inviting me. And I'm going to talk about risk-neutral densities. This is a topic that a lot of people have some familiarity with, and a lot of people don't have any. But everybody knows what an implied volatility for an option is. Everybody knows that you can take the price of an option and solve backwards through the pricing model and come out with what the volatility input would make the price you see in the market consistent with the model. Right? Well, the risk neutral density, you can get an implied volatility for each individual option, but if you take all the options together, you can pull out an entire probability distribution over the final stock price at expiration. And the first time I heard about this was, many years ago, and I thought, wow, that is fantastic. What a useful piece of information. You have a bunch of option prices, and we know that the market is trading options. And from those, we can extract the entire probability distribution over what's going to happen at expiration day. And that's obviously much more valuable, much more information than just an implied volatility. So I started writing papers on this. It turns out that this is such a great idea. It first came out, by the way, Breeden and Litzenberger published a paper back in 1978 showing how to do this. How to take a continuum of option prices and extract probability distribution from it. But since then, lots of people have tried to work on this, and it is really, once you start trying to work on it, the data is messy, and you end up having stuff that is really hard to deal with. And a lot of people at that point say, I can't take this, forget about it. But I'm not being as smart as some of the other people who realized that they should bail out of this topic early. I kept doing it, and I've written a number of papers on this, different aspects of this topic, because it seems like it's such a powerful source of information. Our problems are, first, how do you get the actual distribution from actual option prices? And then second, when you've done it, how do we interpret what it's telling us? And that's one of the whole problems we have already with this implied stuff. You get an implied volatility. What is it really telling us? It's not just the forecast of what the actual stock price volatility is going to be. It's that forecast modified by the risk attitudes, the risk preferences, and all the other kind of speculative motives and everything else that causes people to want to buy or sell options that isn't in our standard no arbitrage pricing models. All right? So when I start talking about risk neutral densities, I always get all excited, so I have to take my coat off, right? All right. So I've written a whole bunch of papers on this stuff over the years, and all of them, there's a lot of problems. And I learned that certain things that I thought would be a good idea to do, you just really can't do it given the quality of the data that's available. And so I found out some ways of managing the data problems, and I'm going to show you the results of some of those approaches. And I've learned certain things you just can't do. But one thing that was always a problem was the data quality. You need a lot of options, and you need good pricing of these options. And so individual stocks, you don't have enough options traded, and there's enough noise in the pricing. And so the one market where you can really, I felt, really, if you're going to try and make this idea work, you want a market that is very broad, very liquid, very important, everybody looks at it, and very low transactions costs. And the market, the ideal market for this is the E-mini futures it's a future on the S&P 500 index, and the options are options on the future, but the future at maturity is set equal to the index, so the options that mature on that same date are also paid off based on the level of the index on expiration day. So this is one of the most active markets in the whole world, and transactions costs are really low. But I retired a couple years ago. I was kind of drifting away from doing, active finance research. I'd published the last paper that I had been working on, and I was going in other directions. And then last spring, two things happened that turned me back towards finance research and today's paper. The first one was that I got a thing in my email inbox saying the Chicago Mercantile Exchange is making their entire history of E-mini options available for $2,000. Now, $2,000 seems like a lot of money, but when you start thinking about buying data, that's very cheap for that amount of data. And then when I contacted them, turns out, well, for academics, it's $1,000. All right, so that got me started. The data is there. And the second thing that happened was I got invited to give a paper at a conference called Beyond Black and Scholes, 50 years of Black, Scholes, and Merton. And this was being given at MIT, and I was invited to give a paper. So there is no way I could turn down that kind of invitation, right? So I didn't, even though I didn't have a paper. So I hunkered down, and I got the data, and I worked hard, and I worked on anything since I was an undergraduate doing my undergraduate thesis, but I produced a paper, and that's the paper that you've got. It's very much work in progress. All right? And as I was getting ready for this, I thought I should really, solidify a lot of what I'm doing here, rewrite the paper so it's all tidy and neat. But I didn't finish that aspect of it. So the paper you've got is the one that I gave at this conference. And in essence, this is like the first time out, because at that conference I had 20 minutes. And you can't really give much of it. Okay. Out in television land, are we okay now?
I think so, yeah. Sattva is on the call.
Okay. So the model, the conference was focusing on the model, and we've seen for 50 years how the Black-Scholes model works, how it doesn't completely work, and how we've spent a tremendous amount of research effort trying to enhance it and get it to work better and so forth, and expanding the realm of no arbitrage pricing models. But in the end, no matter what you do, there's always a good bit of option prices you can't capture with the model. And people like Anderson and Northwestern has kind of given up a little bit on trying to explain everything. He says, okay, we've got this model that is a standard no arbitrage model with stochastic volatility and jumps and this and that and the other thing. And then we have this other left tail factor that we can't really understand, but it just seems to be independent of everything else. So my feeling really is, I honestly feel we've gone well past where we can actually get much more insight from the kind of no arbitrage models that we're building right now. And a lot of stuff that if you ever talk to actual option traders, they say that goes into pricing are things like emotion and sentiment and expectations and so forth, not to mention beliefs that the returns generating process may not actually be a log normal diffusion, might have fat tails, might have something else, right? Well, so what I was thinking is that if we want to understand the part of option pricing that we don't understand yet, what we should do is try to model the difference between the Q distribution, the distribution that goes into actual pricing options in the market, and the distribution that whatever you could get from Black-Scholes and the kind of, well, let's say taking Black-Scholes as a benchmark, we want to explain the difference between how actual options are priced and what we can explain with Black-Scholes kind of things. So that's my goal in this paper. And so what I've done is I've generated a whole bunch of Q distributions, one distribution for each day of 55,580 days. And I've been looking at them and how they behave, just beginning to scratch the surface. And what I feel like, I'm a little bit embarrassed about giving a paper that has so many loose ends in it. But on the other hand, what I'm trying to do is I want to think of this is like a data mine. This is the risk neutral densities can be used to analyze a whole bunch of different questions, important, interesting questions in finance. And I'll give you some examples, and I'll talk about some other things we could look at. And since I've only been able to look at it, I'm going to make the data that my risk neutral density is available to everybody. You guys want to work on it? I think this is a good area to work in, and so I figure that there's a lot that can be done with this. I'm eager to have it done. So let me show you where we are. So this is kind of overview of what I want to do. First thing, how do you extract the Q distribution from option prices, and how am I going to set up what I'm going to take as a benchmark as the P distribution. The P distribution is meant to be, this is the objective probability distribution, and the Q distribution modifies this by putting in effects of risk preferences. So first I'm going to show how you get the Q distribution, then let's look at, the Q distribution contains information about the returns generating process, what the market expects the returns generating process to be, and also risk preferences. So let's generate a P distribution that reflects the factors that are contained in no arbitrage models and see how the Q distribution changes as how it responds to the kind of factors that we're always putting into all of the models we've been building up to this point. Second thing is, okay, so that's how does the Q distribution respond to the no arbitrage factors? How does the Q distribution respond to the sentiment factors? And so I show you a couple of sentiment measures. One is the Michigan Consumer Sentiment Survey, and another is this yield spread between BBB corporate bonds and treasuries. So that's a measure of somehow of the risk premium in the bond market. Right? Another thing that's really valuable about the Q distribution, which makes it different from a lot of the data that we do research on, is that it's available in real time. It's available in continuous time. So it's not like you have weekly or monthly or quarterly observations you have to work with. You can get as many observations as you can capture data for in the course of a day. So one thing that I have done, one study I did with the Q distribution was to look at what happened during the day when the Federal Open Market Committee announces a new interest rate. All right? It happens. You can tell exactly what's going to happen. The information is released at 2 p.m. And with intraday data, you can just see what the market is doing up until the information comes out. The information comes out, the market goes jumping, bouncing back and forth, up and down, and takes for the whole rest of the day before it settles down. And I'm going to show you some stuff in a minute with daily data that looks like, in fact, maybe the big effect is happening in a couple of days after the announcement. I'm not entirely comfortable with that result. Like I say, I'm showing you stuff that is very much work in progress. So any thoughts you might have, and at some point I'm going to ask you whether, would you like it this way, would you like it that way, and you can tell me what makes sense. So, wait a minute, there we go. Okay, so how do you derive the Q distribution? The thing is, when I first saw this, I was astonished at how easy it was. It just seems like it ought to be harder than that, because it's such an important, valuable piece of information. All right? So this is in one page how you do it. We start with the value of a call option with a strike price of X is the present value of its expected payoff. And the expected payoff is how much it's in the money, integrated over the range that it's in the money, times the risk-neutral probability density over the final stock price. Take the derivative of this with respect to X, first partial with respect to X, and already we've got something that's extremely valuable. All right? The X disappears, and we got minus the integral of the risk-neutral density from the strike price X up to infinity. Right? So there's the Q distribution. What people have focused on up to this point is the density. You like to see that bell curve or something like that, right? And so you can take the derivative again, second partial derivative of the call with respect to the strike price. That gives you the density. What I've learned is that probably not worth doing it. The density is just too ugly and messy. Or if you're not going to allow it to be ugly and messy, then you have to put so many constraints on it that you get away from believing that it's really the market rather than your own assumptions. Right? Same kind of thing you can do with a P distribution, and it's nice. That's nice because the way the market works, the options that are out of the money or at the money are going to be traded. Ones that are way deep in the money hardly get traded. So if you're only looking at calls, you can look at one side of the distribution, but really not the other side. And so with puts and calls together, you can go out into both tails, and there's a place in the middle where they overlap. Now, this partial derivative business, everybody's familiar with math and can see, yeah, okay, all right, that works. But the intuition of why it works, I think it's useful to think about it. So suppose we got two different put options, one with a strike of 100 and one with a strike of 101. All right? We look at expiration day, what's the payoff on the 100 strike option going to be? It's going to be 0. This is a put option, right? If the stock is above 100, then the option ends up out of the money, it's worth 0. If it's below 100, it's the difference between 100 minus whatever the stock price is. The 101 strike put, if the stock is below 100, it's going to pay off the same as the 100 strike put plus $1. So the difference between these two prices is telling us information about the probability that you're going to be down here below 100. Right? except for this one little bit here. Right? There's one little bit here is where the 101 strike put is in the money, but the 100 strike put isn't in the money yet. And so if we're looking at the total value of the 101 strike put, it's equal to the payoff on the 100 strike put plus $1, plus this little bit in here. Right? If we ignore that little bit, then we can just solve this and say the probability that the stock's going to be below 100 is the future value of the difference in their the market prices for the two puts. Right? Actually, we can correct for this. We can get an approximate value for this thing. The payoff in this area is, well, $1 at this end, 0 at this end, so about $0.50 on average, multiplied by the probability that you're going to end up in here, which is what we're estimating. I mean, we're estimating the
불렀어?
probability distribution.
뭐,
So
왜,
we're going to get an estimate.
보고 있잖아. 봐봐.
With call options, we got the same thing in the other direction. If the stock is above 101, then both of them are in the money. And the difference between the two is going to be the present value of $1 plus a little bit of this triangle down there. And in the limit, as the two strikes get close, arbitrarily close together, the value of that goes to 0, and then we're left with the Breen and Litzenberger formula. All right, so the formula that I'm using here is basically to convert the partial derivatives into differences, right, finite differences. Then I'm going to adjust with the value of that triangle. So this is a little tweak to the idea. Right? Okay, so that's how we get the Q distribution. How do we get the P distribution? Well, suppose you're thinking about, I want to use the Black-Scholes model the best way I can to predict the payoff on an option. What would I do? Well, I got the Black-Scholes model. I've got all the inputs except for the volatility. So now I got to forecast the volatility. How do I make the best volatility forecast? I'm going to use historical volatility I've seen over the last period of time. But also I know that the VIX has a lot of information about volatility that's not included in historical volatility. So what I'm going to do is, standing here today, I want to forecast volatility between now and the third Friday of the month of December, which is about 30 days from now. All right? So I'm going to look back over the last 3 years and see if I wanted to make 30-day forecasts of volatility using 25-day historical volatility and the VIX, and I can see in the past what the realized volatility was, and so I can run a regression of the realized volatility on historical and VIX over the last 3 years. So that's what I'm going to do to get a P distribution. Right? And that's basically what I'm describing on this.
Quick question, Steve.
Yeah.
So that is that volatility then strike specific? So you're doing it for each strike differently, or using one common?
No, I'm trying to forecast the volatility of the underlying S&P 500 index. It's maturity specific, but not strike specific. I'm going to use the same vol for the P distribution. So there's no smile, right? I actually think the smile is at least part of what I'm trying to explain with the Q distribution. Right? Okay, here's the data briefly. I've got quarterly maturity. So these ones have been traditionally by far the most active. We've got futures that mature March, June, September, December on the third Friday, and a whole flock of options with different strikes that are based on those futures. Right? I restrict, in what I'm going to show you today, I've restricted time to expiration to 10 days to 90 days. Average maturity is 45 days. I think I should use more, shorter maturities too. But if you go in the last couple of days before expiration, you're in a very messy period. You know, but I think I'm in the process of kind of redoing things right now to tighten it all up. I think I'll use 5 days. I averaged the bid and ask quotes and required that the minimum price is, that I can use is 10 cents. Right. Below that, you end up, even that's kind of noisy, but. Okay, for the Black-Scholes model, I use, for riskless rate, I use a 90-day T-bill rate. I don't particularly like that as a good interest rate, but I don't think it makes a whole lot of difference, so I just picked it because it's easy. Use the level of the S&P index, downloaded from Yahoo. I use 30-day VIX, also downloaded from Yahoo, and the other data, Moody's yield spread series and Michigan Index of Consumer Sentiment. So, if I do what I just described to you and get an estimate of the Q and Q distribution, this is what I get. This is just for 1 day. For 1 day, I picked it at random. It turns out to be a useful day. January 18th of this year. And the red one is an estimate of the Q distribution from put options. The blue is from calls, and everything you're going to see after that averages the two. But you see it's pretty chunky there, right? It's, and now we're going to try and calculate densities by taking the difference between these two. You can see how much noise is going to be in there. That much noise. Right? If you try and calculate, just apply the Breeden-Litzenberger formulas without worrying about it, you end up with something like this. And it's even uglier than this because there's a lot of negatives that I've chopped out by putting the minimum of the graph at 0. So people try to smooth these estimates. There's a lot of different ways people have tried. The simplest way is to assume a parametric distribution. You know, I'm going to stuff everything in as a student T or a normal inverse Gaussian or some other kind of distribution. Obviously, if you do that, then you're basically telling the market that I don't want to hear anything that isn't this distribution, which is obviously ruling out a lot of things you might not like to rule out. An alternative, people use a mixture of normals or Hermite polynomials or Graham-Charlier approximations to a distribution. All right. Again, you're posing a distribution. You're not making as strong assumptions, but you're still imposing a distribution. A lot of people are doing now would be, you just do what I just said and then try and smooth things out using like maybe a cubic spline or something like that. I tried to do that and you end up with a lot of messy stuff. Right? One of the best ideas was originated by David here. Early on, when people were not really doing this stuff at all, he said, let's take the option prices, convert them into Black-Scholes volatility. So now we've got a volatility smile, and that smile is usually pretty well behaved. And so now using the smile, you can fill in with a whole lot of extra points, convert back into prices, and now you've got a pretty smooth set of prices. Very nice approach. I tried to use that for a while too. But you still end up with a lot of problems. And one of the big problems, of course, is you don't get the tails. You can't get the tails beyond where the strikes are, the options are in the market. So here's a different idea. This is something I came upon. I'm a little uneasy about the statistical underpinnings of it, but here's the way I'm sort of thinking about it. Suppose my just looking at put prices, I'm going to look at the change in put price between one observation and the next observation. The difference there minus this adjustment divided by the change in the strike. That's our estimate of the Q from puts. But each one of these, this is like the true price, and then it has an observational error on it. And so we've got an error here as well. So what I thought about doing, what I saw actually kind of works is, as you saw from the jiggly Q distribution, red and blue curves I just showed you, right? There's a lot of noise at the very short interval. Suppose we take differences over a bigger interval. Instead of taking from observation I to I plus 1, let's take it from I to I plus some other number, 3, 5, 10. Right? I find 3 works pretty well. Now, the error part is still, we've got the error of each one of the individual things, but the denominator has gotten bigger. So the general size of this factor stays comparable, but the errors get smaller if you take differencing over Q steps. And so there we go. So with 3-step differencing, that looks a lot better, right? One thing that I've done here, by the way, the first one of these pictures I showed you, the x-axis was the level of the index. That's fine, except if I want to compare one day with another day, I don't want to have the big difference between them that the index was different. So I convert everything to gross returns. The return at the stock price at expiration divided by today's futures price. Right? And so we get numbers that are all in the neighborhood of like 1.9, 1.1, and so forth. So then I can kind of average these guys over time. So this is what happens when I have taken a multi-step difference, the distribution function, and now I calculate the density. It's still pretty ugly, but at least it's got kind of the right shape. The label up there saying it was 10-step differencing is incorrect. So what do we see? Well, in this picture, take a look. It's all very, very chunky, but look over here. Okay, here's the left tail. We can see that on this day, the risk-neutral density is a lot higher than the left tail than this benchmark P distribution. It's a lot lower for small losses, a lot higher in the area just above at the money, and it goes to 0 at the upper end much faster than the P distribution. So we got a fat tail on the left side. You know, we always talk about market returns of fat tails. Well, the left tail is fat, but the right tail is thin. The right tail of the Q distribution is lower. The probabilities are lower for high returns than the P says that you should have. Another thing that you see very clearly is it's left skewed, right? The log normal is a right skewed distribution, so we're way off on that, on the skewness. Now, suppose we average over the entire, by converting everything to gross returns, now I can average over the whole sample. I do that, and things come out pretty nicely, and this is the pattern that we see. Fat left tail and thin right tail. And here's what the density looks like. Averaged over 5,000 things, smoothed also. So now I'm going to show you results from how does the Q distribution change when something happens. Whether there's a big return, there's a jump, there's high volatility period. Right? And in order, it's a little tricky to interpret some of the the numbers. So I want to show you what happens on one day as the market moves and the Q moves with it, and we can see what happens to the shape. The top picture, this is the Q density on January 17. And I'm going to show you what happened on one day later, January 18, which is the day we've been looking at up to this point. So this is the day before. The index was at 4,000 and somewhat a little bit above it, and it's going to go down a lot. Right? All right, so that's what we have. Now, when we standardize it to gross returns, it looks basically the same. It's moved a little bit. But what changes is what happens when you get a change from one day to the next. So from the 17th to 18th, the market drops by about 1.5%, something like that. And in the top, as we expect, we see that the P distribution has moved from the dashed level to the solid, and the Q has also moved. So as we expect, the Q distribution has moved down. But what this shows is how it's changed relative to the P. And that's what I want to look at. I want to say, how does the Q distribution, which is reflecting emotion and everything else, how is that different from the P distribution as only the no arbitrage type factors in it? So I want to see how this changes. And you can see how it makes quite a difference. Over here, it really looks like, gee, the probabilities of this level have gone way down, or maybe say it differently, that this has moved down that direction. But when I want to see, well, how did it really change once we've taken out what happened to the P distribution? There's not really much change here at all. Where things have really changed is right here. Right? So that's something to keep in mind when I'm going to show you the results of what happens when there's a big negative return. Well, the Q distribution is going to move, but the P distribution is going to move too. And what the results are going to show you is how the Q changed relative to the P. Okay, so now here's a whole flock of tables. I'm trying not to kill you with them, but let's start with looking at how different sections change. This is like quantiles. And so I've split up the possible returns. This is in terms of the strike prices, right? The index is at 4,000. A 3,500 strike option will be in the money, a put will be in the money only if the stock has a return that goes from 4,000 to 3,500 and below, right? Well, I'm showing this in terms of standard deviations. And as I do it, this is one of the places where I'm going to solicit what you guys think. Right? Because I could also do it in terms of percentiles, 10th percentile, 20th, 30th, and so forth, right? In some sense, percentiles may seem more intuitive, and yet if we're thinking about probabilities, maybe standard deviation, sigmas, are more relevant, and the percentiles are in the first row anyway. So I've got 11 buckets from -3 standard deviations, -2 to -3, and so forth, all the way up to +2 standard deviations. So the market goes way up. Why not +3? There aren't any options to trade with those strikes. They don't trade the upper end of the distribution. Right? And what are we looking at here? The P distribution at the break point here. Right? So the P distribution at -3 standard deviations is 0.001. At -2 standard deviations, 0.023, and so forth. Right? This level, this one, is the Q distribution at -3 sigmas on the P, right? Or -2. Right? So we can compare how they look the two distributions look at that level. And here, those are the values at these breakpoints, and these two rows are the probabilities within those buckets. So to focus just on two things, let's look at this one. This is the left tail. Right? So we go out to way out to the far left tail, more than 3 standard deviations down from where we are right now. The p distribution says there's 1 chance in 1,000 of that happening. Right. The q distribution says there's almost 5% chance of that happening. 47 times the probability. 2.3% chance of being down below 2, minus 2 standard deviation. 9% chance for the q distribution. Now, of course, because they both have to add up to 1 in the end, the p is going to have to catch up. Right? When we look at what the probabilities in the intervals, it's interesting here. In this interval between minus 2 and minus 3, there's 4% probability according to the q, 2% probability according to the p. But by the time we get up to this range, down in that range from minus 1.5 to minus 2 standard deviations, that's a pretty big down move. They're pretty much the same. It's really the way remote tail where the q is much higher than the p. Here's the other end. Now, actually, if at any point, you guys have been very quiet, if you like to say anything or ask questions or something, tell me what I should be doing differently, be sure you do it. So here's the upper tail. And we can see that by this time, the p and the q are pretty much together, except the p is going to 1 more slowly than the q is. The q, by the time we've got to between 1.5 and 2 standard deviations up, the q distribution says there's only a little over 1% probability of being higher than that, and the p says there's 2.3%. Well, that's kind of how they compare on average. Let's look at how the q distribution, what it does when we see things that normally affect option prices in our models. And I add 4 kinds of things. Log return, return squared, jumps, up and down jumps, and then a separate variable for for positive versus negative returns, up market and down market, right? I can't show you everything. I can't even show you much of these things. I've looked at tables like the one I just showed you that have like a lot of different buckets. That's one way of looking at these sort of things. Here's another way of looking at it that's kind of more analogous to what we normally look at when we're looking at no arbitrage models. We want to look at the mean and we want to look at the standard deviation. Well, we can't have either of those for the q distribution because we can't get the tails. But we can get non-parametric statistics. So instead of the mean, we can use a median. Instead of the standard deviation, we can use the interquartile spread, the spread between the 75th percentile and the 25th percentile. And of course, we could adjust that. If we want to look at more remote tails, we can look at other sections as well. But anyway, I've got a bunch of results on looking at the median. So suppose we have a positive return. Right? The q median goes down. We have a negative return. The q median goes up. Hard to, I don't have a whole lot of intuition for that result. It's more meaningful, I think, to see that the Q changes relative to the P median, and we get the same sign of the coefficients, and they're more statistically significant. So you get a positive return, the Q median, the Q median is lower relative to the P. And I suspect this has to do with the skewness effect. Go ahead, David.
I think we all are indoctrinated by Black and Scholes to think about how the stock moves, which cause the future distribution to shift. But maybe there's another model here, which is the distribution is more or less fixed, and the market sort of corrects the pricing. But the terminal distribution could be staying closer to the same. Would that explain the phenomenon you're talking about?
Maybe. That's sort of another way of saying that it's sort of that people are expecting not continuation but reversal, right? Yeah, I see some evidence of that. I do see some evidence of that. I'll try and. There was I hesitate there because I know that there is one result among these tables that it speaks directly to that issue. If the return is negative, right? This is it's tricky to interpret some of the numbers in the tables, and so I'll try and point out to you when you have to pay special attention. If the return is negative, a negative coefficient times a negative return is a positive, right? So the change in the interquartile spread for the Q distribution, negative return times a negative coefficient says it widens out. If you get the negative return and it gets narrower with a positive return, and relative to the P, it's not as strong, but it's just as statistically significant. Suppose we add some more things, some risk variables. Here's return squared, right? So that's adding equivalent to a volatility or a standard or a variance kind of factor in here. What I find is that it doesn't necessarily behave the way you would expect it to. So if return squared is a big return, the Q median goes down relative to the P. I have some trouble kind of understanding how some of these results make sense, but a lot of them make a lot of sense. Like here, if you have a really big return, positive or negative, the interquartile spread widens out, but relative to the P, it gets narrower. I don't know. I think that because one is positively skewed and the other is negatively skewed, a change in the skewness will affect some of these variables as well. So this bears further examination. What do we see from jumps? Turns out, this is T statistics, negative jumps don't seem to have as much impact as positive jumps do. Right. Coefficients are smaller and less statistically significant. A negative jump, the market goes down, times the negative jump is negative, right? Times the negative coefficient says that the Q interquartile spread widens relative to the P, and positive jump, it gets narrower relative to the P. So this is kind of what we're anticipating. All of this stuff, I think, could bear further look at some of the detail. I don't want to linger on this too long because I want to show you a couple of other things here. Tables 2 and 3 that you've just seen some samples of, look at how the P and the Q are different and how they respond to the kind of returns-based variables we normally put into our models. This table looks at the things we don't put into the models, specifically measures of risk preference. So I don't want to get boggled too much with numbers. This is like almost the last table. But so let me show you what's in it. This section, we're looking at changes in the median, and this section, looking at changes in spreads, the risk parameters. So look at the Q median. I'm going to explain it with a couple of the no arbitrage variables, and I've put the others in there too, but I don't want to have too complicated tables. Plus adding the default spread on corporate bonds and the Michigan survey. And so let's just look quickly at the returns. The results from the returns, take my word for it, there's hardly any change. Right? Those aren't really affected by the sentiment variables. When we put the sentiment variables in, though, if the yield spread is wide, the Q median is low. But not quite as low as the P median. But when the yield spread is wide, the interquartile spread on the Q is wide too, with a t-statistic of 41. But not really so much different from the P. So we're seeing an effect, but we're not seeing an effect relative to Black-Scholes. Michigan survey. If the survey is high, that means people are confident they like it. Q median is low. Why is that? If it's below average, then the Q median is high. But when we look at the spreads, the effect on the Q seems counterintuitive and strong. The difference between the Q and the P, though, is kind of the way we expect it. So that, no, it isn't. No, it isn't. This is also counterintuitive. Right? If the, is it? If consumers are confident, a positive coefficient says that the interquartile spread between is greater for the Q than for the P. As you can see, I've got a little issues here with the interpretation of this, and I think there's a lot to be improved on this in this table. And one thing that I know is wrong with it already is that I had, based on what I saw in Wikipedia, I treated the announcement at the level of the Michigan survey as being known at the very first day of the month. That is, in fact, not true. All right? And so that's something that has to be adjusted. But my point, one thing that, whether we like the coefficients or not, they are highly significant. All right? So there's something to explain here. Go ahead.
Do you think there's more information to be gained from the regressions with just the Q median or the Q spread, or the change in Q median and the change in the spread?
Depends on what we're trying to understand. But for these kinds of things, a Michigan survey comes out like once a month. So the change in the survey, you don't expect to have much of an effect, except these days it does. These days there's an announcement effect for the Michigan survey. But I don't think that's probably true for the entire sample. So something to be explored. But yeah, that's why I wasn't really focusing on the changes on this table.
Yeah, because a lot of the changes aren't significant for here. So
Yeah,
wondering
yeah,
if that's the
yeah,
case.
yeah. Well, see, these, I did this, I've done this paper in haste, and there's a lot more to be done to bolster it, and put it together. But what I wanted to show is that the Q distribution is capable of telling us stuff about how sentiment enters into pricing of options in a way that the models that we normally use don't. Okay, last thing I want to show you in the last 2 minutes, that one of the great things about this is that it's available all the time. You can see what happens as a piece of information hits the market, and if you've actually watched this happening, as I've been watching the last couple of years, the Federal Reserve announcements, the number comes out at 2 p.m., and the market responds instantaneously. At 2:30, Jay Powell gives his discussion of Fed policy, and the market has another response, and oftentimes it's completely opposite. But what we can see, we can study in minute to minute what's happening in the market with this tool. Right? So what I did was look at the interquartile spread of the Q distribution day by day over the 5 days before the meeting, and the 5 days after the meeting. The meeting happens at time 0. And what we can see is as the meeting is coming up, the spread is getting narrower and narrower and narrower. What I saw when I looked at this intraday was that at 2 p.m., bang, big excitement, a lot of movement in the market that would kind of peter out over the course of the day. What I'm seeing here with the daily data is that, well, the spread keeps going down, and then suddenly, 3 days later, it explodes. And like I said, I've done this in haste. It's possible that this result is spurious, but it's also possible that this is something that hadn't really understood before. And let me just show you a picture of it. I made a difference between the spreads when the blue is the average, what we just looked at, right? The red is when the rate goes up. So you're going to raise the rate, suddenly things get a whole lot riskier a couple days later. If the rate goes down, I think the expectation is the Fed is doing something to help the economy, and so things aren't quite so bad, but still get a lot more volatility. And the purple is they didn't do anything at all. What explains this? I don't know. I think it's worth looking at a lot more, but one thing I can say is that this is a Wednesday. This is a Thursday. This is a Friday. And now we have a weekend, and now we're at Monday, and Monday is when everything explodes. Maybe it takes a weekend for people to figure out what the Fed really was talking about. I don't know. Anyway, in conclusion, I know you've gotten the idea that I think this Q distribution has a lot of information in it, and the E-mini futures options are perhaps the market is going to be, one of the markets that is going to do give us the best kind of performance. There's a lot of problems and issues in trying to get to a decent distribution from the data, and I'm trying to do what I've come to feel is best practices at this point. And the thing about the Q distribution is it tells us how the market is really pricing things, not just how highly rational economists who can do solve partial differential equations in their head and so forth, how they would price things. Now, I've already mentioned these other points, lots of option markets, lots of ideas that might be worth doing research on. So in order to encourage everybody to do research, as soon as I've felt that I've got the Q distributions as good as I can get them, then I'll make that data available to anybody who wants to do work on it. And in case you have any hard time thinking of ideas, here's a whole bunch that have occurred to me. I mean, one thing you could look at is, can the Q distribution forecast volatility as well as the VIX? Or what do we learn? And does it forecast actual volatility, you know, the jiggles of the S&P index, or does it forecast future implied volatility, which I think is more likely. It should also be predicting not just how volatile the stock is, but also how volatile emotions are. The VIX index. The VIX index uses the same option prices, but compresses them all into a single number. And a problem I've always had with the VIX is I'm not clear on what that number actually is. You try and look at, is it the volatility of the at the money, out of, it's not the at the money option. The out of the money option is some kind of blend and so forth. I don't have an intuition for it. I do have an intuition for the Q distribution. If we want to find out what is the VIX, what is it? It might be worth looking at how it relates to the Q distribution. The Q and sentiment indicators, there's all kinds of sentiment variables that one could look at. Another idea that a lot of people are beginning to look at, and I haven't done at all, maybe people have done here, is textual analysis, you know, newspaper articles. The first forecast issue is forecasting volatility, but can the Q components in some way tell us anything about returns? I don't know. Might it be possible to find a pattern, a shape of the Q distribution that would indicate the market is fragile in a certain direction, so that if a bad piece of information comes out, the market really tanks. If it doesn't come out, well, no biggie. I don't know. And of course, one can apply all the same methodology to other indexes. I just saw at this conference that I've told you about, Doug Breeden, who's still, Breeden and Lissenberger is still doing research and was reporting on something that they recently did on forecasting short-term interest rates using options on, was it on Eurodollar futures? Something like that. Anyway, it was short-term interest rates using Q density. So, well, I'm out of space and I'm out of time, but there's lots of ideas left, and thanks for patiently listening to me promote this idea.
Any questions?
Go ahead, yeah.
So your last graph in the presentation, I thought that was really cool. And I had one question. So you looked at kind of stratifying it on if rates went up, down, flat.
Yeah.
I'm curious if you looked at all if rates moved in accordance with expectations versus against expectations, things like that, how that looks.
That's a great thing to study. I need the expectations. Do you have the expectations? Do you have a series?
Aren't they on, you could find them on Bloomberg, no?
Yeah, all the way back to, or how far back do you think? Yeah? Definitely something to do.
All right.
Definitely something to do. Yeah, David.
The first question is the number after the number below the coefficient, is that standard deviation?
Key statistic.
Oh, yeah. So from those numbers, I noticed not all of them are significant. So is the results stable, or we can just regard them as noise?
I thought that a lot of them were big. Did I misunderstand? Now, this one, This is the sentiment one, right? We have a lot of, these are all T statistics, right? Those look pretty significant to me. There's a couple of small ones.
Yeah, so the regression regarding the delta terms are not so significant, I think.
No,
Even for those.
well, this one, I don't expect to have any significance. This is the monthly Michigan survey. How does that affect the change, the daily change in the Q median? And so the timing on those variables doesn't seem to work properly. So for the Michigan survey, I would certainly think that the level would be more important. This one does this one does change daily, so you can look at the change of the. We can look at how this affects the change in the median, but we're not looking in the. I'm not looking at the change in this spread that would affect the change in the median. So again, I'm not sure that would be relevant. But I agree with you that this is rough. This is, you know, I just got some data and ran some quick regressions on it. But if you wanted to look at it more deeply, you'd want to look at it more deeply.
Okay, thank you. And my second question is, how do you define the Q and P spread? Is it defined at a specific point, or is the overall spread like? Since previously we can see in different positions they have different relationships, and why we do not study them separately?
I apologize. My ears are not very good, and the last word you said I didn't get.
Separately?
Separately.
Yeah, like we just study the left tail and the right tail, and in the medium.
Yes, yeah. Well, one of the things that I particularly like about getting the whole distribution is you can look at whatever piece of it you want. The near tail, the large tail, the very far remote tail, and so forth. And for the most part, when we are using, statistical distributions to model the stock returns, we're ending up with things that have a right skew and fat tails. Right? Student T distribution, people like to use the normal inverse Gaussian and all of these. The idea is to have fat tails, but when you actually look at the distribution of actual returns does have a log normal type bigger right tail, but the Q distribution doesn't. So that's a difference between what we might think of as our best guess of what the actual returns distribution looks like and what's getting priced in options markets. That's the difference.
I'll take my questions to dinner, I think. But thanks to everyone for attending. And once again.
Well, thank you. If you look at the slides or the paper or anything like that, if you have any ideas, be sure and send them to me. I'm eager to. I'm working on it right now. I was working on it this morning. What I'm doing actually is just to be sure that I've got the numbers all right. It started over from zero, and I'm duplicating what I did and making sure. And I find a little tweaks. Oh, this one I should have done a little differently, and so forth. So as you will learn by the time you end up writing publishable papers, that it isn't over until long past you think it should have been over.
Just like graduate school.
Yeah.
Right,
Yeah, well, that's one thing, in graduate school, you write a paper, you turn it in, you get a grade, it's done. When you're a professor, you write a paper and you send it off to a journal, and the best you can hope for is it comes back and says, this really sucks, but you know, maybe I could consider if he wanted to do this, that, and the other thing to improve it. And you go back and forth many rounds, and long past when you think you've done it, they're still coming back and saying, well, yes, but this isn't formatted properly, and couldn't you add different spelling and that? It's never over. So.
Great advertising for the PhD career, though.
Well, but it's a wonderful life. Being a professor, it's a terrific life.